Good morning and welcome back to Blockware Live. We have a really big episode today, a lot of important topics to get into. You guys are in for a treat, truly, and I mean that. And we're going to go very deep on the Japanese bond market, the implications for Bitcoin, but also the economy more broadly. And we're actually going to get the opportunity to time travel today. I know that sounds crazy, right? I'm over in Looney Land talking about time travel, but what's happening in Japan is, I believe, a forward-looking example of what will happen in the United States. I believe the underlying circumstances in their economy are strikingly similar to what's happening in the US. We're just about a decade or a decade and a half behind them, but we're headed in that direction over the medium to long term. So I believe we can learn a lot by looking at Japan, and it can help us prepare as investors and just Americans in general or Westerners in general for our future economic conditions. So we'll elaborate on that more later in the show. We're also going to be talking about the weather and this crazy winter storm that's going to hit the United States and what this means for Bitcoin miners. I know it's every child's dream when you ask them, hey, what are you going to do for a living when you grow up? I'm gonna sit there and monologue for 45 minutes about the bonds and weather. I know, I know, it's exciting stuff, but jokes aside and facetiousness aside, these are very important topics. And here's a challenge. Try to talk about bonds and the weather while also being entertaining. Give a 45-minute monologue at a undergraduate to master's degree level about the bond market while not putting the audience to sleep, while not sounding like a boring college lecture. That's what I'm going to do for you guys today. You guys are going to leave this, and for the first time in your life, you're going to think to yourself, man, that conversation, that monologue about the bond market, that was so interesting. I am fired up. And I'm going to do that for you guys today. If The Big Short can make bonds sound interesting, then so can I, right? Because that's what that movie was. It was a movie about bonds, but it had everyone on the edge of their seat. Now, that was mortgage bonds. We're going to be talking about sovereign bonds today, which have a bigger scope and impact. This is the reserve asset of the world is US Treasury bonds and other government bonds, right? This is what our entire economy is built off of. And it's purposefully a boring topic at the high level, right? You're lending money to a government or another entity and they're paying you back. There's nothing fundamentally really exciting about bonds, and this is by design. And we'll unpack this a lot throughout this episode and future episodes, but it's kind of malicious that it's that way, isn't it? Half the people in the world don't even know that government bonds are what is the bedrock of our entire economy. And what these instruments do is they do rob from people. You receive a fixed payment over the life of the term, but the actual purchasing power that you receive goes down in time. It's crazy to think about. And we'll unpack it. I mean, it's an IOU. The base asset that most people have, most investors, most pension funds, most banks, most governments, it's just an IOU. It's a government literally writing I owe you on a piece of paper. That's what a bond is. Hey man, I'll get you back, What's your Venmo? I'll pay you back, bro. Like that's literally what the bedrock of our economy is built on. It's not built on a physical bearer asset. It's not gold, it's not Bitcoin, it's not land. It's not a tangible asset that you own. It's someone else's debt. It's someone else's IOU. Bro, I'll pay you back, I promise. That's what our economy is built on. And when you think about it like that, it is a bit scary, I'll say. It's a bit unnerving, but we'll shed some light on it. We'll talk about what's going on in the Japanese bond market, why this could signal a bottom for Bitcoin, and what the implications are for the United States economy. Also, elephant in the room, I've now been late to 3 live streams out of the last 4, and I'll give you a little inside baseball here, and I wouldn't normally share so many personal anecdotes before the story, before unpacking the main conversation of the day, but I think this is helpful as we think about finances and economics, business, whatever. The reason I was late to the show today, and I'm not trying to make excuses, forgive me, but I had to get an appliance in my house fixed. I'm a renter. I I don't buy. I don't live in the buy where I live, and that's a conversation for another episode. I could talk about that ad nauseum, the trade-offs between buying a house and renting a house. But long story short, I rent, and my refrigerator broke. So, maintenance man had to come and repair my refrigerator, and they're gonna have to replace it. You can't fix it. So I live in for more, better for lack of a better word, I live in a dump, relatively speaking. Now, my landlord, I'm putting my you'll see where I'm going with this. My landlord owns this property, right? And he's now about to have to replace a refrigerator. And it's probably going to cost, I don't know how much. I don't know how much refrigerators run for these days, but some amount, a couple hundred to $1,000, right? And so a big chunk of his monthly income from the property is just eaten away by maintenance. And this is the thing that people don't think about when discussing passive income and real estate and rental properties. I'm going to get all these rental properties and I'm going to be cash flow king and I'm going to get all this passive income. And then you have one appliance break and there goes a month's worth of income, right? This isn't a hands on endeavor. It isn't a risk free endeavor. You could just sell the property, buy Bitcoin or buy Bitcoin miners, and you don't have to repair toilets and refrigerators and dishwashers because the dishwasher broke too. I'm not trying to unload baggage or complain here, but the point is real estate is not risk free, it's not hands off, and it's probably the most overrated asset class, in my opinion. Owning a single family home and trying to cash flow it out. Because for me, honestly, I feel like I'm pulling the wool over the landlord's eyes, hypothetically speaking, right? I get to live in a cool house or whatever and just buy Bitcoin. I didn't have to spend Bitcoin or spend the opportunity cost to own a home. I just get to live in it and save in Bitcoin. And I'm not on the hook for fixing the fridge or the dishwasher or whatever goes wrong. I don't have to pay the property taxes. It's like you provide housing as a service and I get all the Bitcoin upside. So that's my 5-minute take on rental properties. Again, very overrated asset class. You hear this frequently in the money guru community. Not as much anymore, but it certainly was a talking point for quite a long while there that hey, just get some properties and just let them cash flow and this is your way to economic financial freedom. It's really not that simple. And I for one have no desire to be a landlord. So, that aside, we'll get into the featured topic of today, which is the Japanese bond market. And it's collapsing, not to be hyperbolic or anything, but they are in serious hot water. And I believe this is going to mark a local bottom for Bitcoin. And I'll explain why. But first, I want to provide a little bit of context. So we'll pull up the screen share because that's always helpful. And we'll look at this chart here. This is the 10-year yield for Japanese bonds. Now, kindergarten level analysis here. Yield goes up, bond price goes down. Yields going up is very bad, especially when you are as indebted as the Japanese government is. You think the United States has a bad debt problem, Japan's is twice as bad. And we'll talk about it. And like I said, I think the US is on the same trajectory. This isn't doomsday type of stuff. There's ways you can prepare yourself as an investor as a capital allocator to position yourself for this, but education is the first step. And so, what we're looking at here is a chart over the past 15 years of the Japanese 10-year bond yield. And you'll notice since 2020, straight up, basically, it's vertical. This means if you're a Japanese citizen or investor, your quote unquote risk free asset, which would be Japanese government bonds, has not been risk free at all. You are experiencing significant nominal paper losses on top of negative real returns. So the Japanese 10-year bond at a decade high yield is offering 2.25% annual yield, while inflation is much higher than that. So you're getting negative real income on top of paper losses with the bond going underwater. Now, what does this have to do with the economy? Why are markets reacting so violently to the Japanese bond market? Well, it's because of the yen carry trade, which gets thrown around a lot for people who are like, man, I hear that, but I don't want to be the idiot in the room to ask, what does this actually mean? Here's what it is very simply. Interest rates are incredibly low in Japan artificially, right? The central bank has done what's called yield curve control, which means they buy the bonds to support it so this doesn't happen. So this, I guess it's this way when I'm looking at the screen share here. They don't want the bond yields to go way, way up. So the central bank will buy bonds. They'll print money and buy the bonds. Um, but because the interest rates are still artificially low, you can borrow in Japanese markets, very low rates, and then invest elsewhere. And this is the idea behind the yen carry trade. So we talked a lot on Thursday about shorting weak currencies and going long better currencies or hard assets. And we spoke in reference to the dollar. But the yen carry trade is doing this in reference to yen. So short yen, buy dollars or buy US equities or buy Bitcoin. And so what happens is when the yen actually strengthens relative to the dollar specifically, the yen carry trade gets underwater or they get margin called, right? If you have outstanding liabilities in yen, the yen goes up, then you have to sell your other assets to cover your margin on your yen loan. And so investors, they have to sell what they can, which tends to be Bitcoin first, right? Because it trades 24/7, 24/7 billions of dollars in daily trading volume and liquidity. They sell what they can to cover their margin. And so we actually saw the yen carry trade not blow up entirely, but certainly had a hiccup last year. Well, I guess 2 years ago at this point in July, August of 2024. Let me zoom this chart in a little bit, switch to the daily candles here. You can see here on the 10-year chart, the back here, the yield dropped. Now, if we switch over to dollar yen, which measures the relative strength between the US dollar and the Japanese yen, and we zoom into August of 2024, we can see that again here. Big drop in dollar yen. So this was the yen strengthening relative to the dollar, which was going against the broader uptrend, right? Which was dollar strengthening against yen. They did yield curve control in Japan, right? Central bank prints yen to keep the yield on the bond lower artificially. That weakens the currency. They were debasing the currency. And so you can imagine how bad the inflation is when the dollar is strong relatively, right? The dollar being strong in comparison to the yen means the yen is incredibly weak because the dollar itself is not strong by any means when you compare it to hard assets, gold, equities, Bitcoin, real estate, right? We have to get this out of our mind that the dollar is just some magical thing that is perfect, and has no flaws, right? The dollar, although we use it to measure value, is not in and of itself value. And so it has a value relative to other assets. We just tend to use it as the denominator. But in this instance, yen is the denominator and dollar is the numerator. And you could see over the past few years, especially since 2020, the dollar was strengthening relative to the yen. But in 2024, you had this big moment of relative strengthening for yen. So when this line goes down, yen becomes stronger against the dollar, and that caused the yen carry trade, which was people borrowing yen to buy other assets, to blow up effectively. And interestingly enough, this marked a local bottom in Bitcoin. So if we go to Bitcoin at the same time period, which was Q3 of 2024, right in here, you can see August, September is about when Bitcoin bottomed. This is when the yen carry trade blew up. And so seeing this turbulence in the Japanese bond market and the increasingly likely scenario where the government steps in to debase the yen even further leads me to believe that this is one of many indicators that Bitcoin's bottoming right now, or rather that the 80K flash crash in November of last year was the bottom. And I have a lot more data to back that up, which we'll be talking about in the report, which is coming out to all Blockware intelligence subscribers, free and paid tomorrow. I mentioned this report on Tuesday, but it's our 2026 market forecast. We go very in depth. We look at all of the on-chain data to show what's going on in Bitcoin. And we really take kind of an X-ray vision because that's what's really interesting about on-chain data is you can hyper focus on different cohorts of market participants. Anyways, that's coming out on Friday. A lot of indicators that Bitcoin is bottoming. But if we go back to Japan, which I'll go back to the screen share here, I think Bitcoin's bottoming, but I mentioned we're going to time travel today. And what we've got here is a chart of the debt to GDP. We have Japan in red and we have the United States in blue. And this chart's about a year old, but the conditions are relatively similar as to when I created this chart in 2024. And what you see here is Japan has a debt to GDP of north of 250%. The United States about 120%. Both of them have been on the rise over the past decade. Now Japan hit a debt to GDP of 120% about 10 years before the US. So again, there's kind of this 10-year lag in trajectory. Japan, really high debt to GDP. What do they have to do? They have to do yield curve control. The central bank, the Bank of Japan, has to debase their currency to keep interest rates low. Because if you have a lot of debt, you don't want to have a high interest rate because it's going to make the debt compound even faster. So what loses? What's the trade-off? You have a weaker currency. You have higher inflation. And unfortunately, the United States is headed in the same direction. And we've talked about this a lot, but I want to point to something that I don't see in terms of economics. And that's the population pyramid. So what we're looking at here is a GIF. I'm actually going to switch to the still image because I'm a little ADHD and the GIF bothers me. This is the Japan population pyramid. Zoom in here. What you see on the y-axis is age, and then what you see here is the amount of people, right? You have men in blue, women in red. And so in a healthy society, let me zoom this back out a little bit. In a healthy society, this would actually look like a pyramid. You would have a larger percentage of your population being under 18, right? You're growing, people are fertile, they're making a lot of babies, the population is expanding. But Japan has an inverted pyramid, which is incredibly dangerous because you have more elderly people than you do young people. And the population crisis gets discussed a lot, but not in terms of the economic implications. What does this mean? Well, you have a lot of people that are going to retire, not be working, not be producing goods for society. They're not creating, they're not contributing value. Not that they don't have intrinsic value as humans, that's not the point, but economic value. They are net consumers, right? When you get old and you stop working, and you have fewer young people to produce goods and services, to support your economy and provide economic value. And so what happens? Well, the government has to spend more to support the large percentage of the population that isn't working. This is one of the reasons why Japan has such a high debt to GDP. The demographics are not in their favor right now. They have not been reproducing. They're not creating new human life, right? Humans get older and you die and you get old and you stop working and someone's got to support them, right? Old people have to eat too, obviously. Plus their medical costs tend to increase, right? You get elderly. And so who foots the bill? Well, people that save in yen. And that's the second order, the second derivative effect, right? Technically, the government foots the bill, but they can't generate enough revenue from taxes to do that because you don't have a lot of people working, right? And so they devalue the currency. They pass the cost on to people saving in yen via inflation. They devalue the currency. They print more money to support the elderly aging population. Now, everyone loves to throw around the term baby boomer, and this is not to rag on baby boomers. I don't say this to be, a pejorative or whatever. But we have a lot of baby boomers in the US. And this is the US population pyramid. And you can see it doesn't look quite as bad as Japan, but the baby boomers are not getting any younger and they're going to keep retiring. And additionally, you're starting to see this inverted pyramid shape. You're not getting as many young people. People are not reproducing, and there's a whole boatload of reasons you could point to, but we're not here to discuss that on this episode, maybe another show. But what's happening is you have fewer babies. You have fewer young people that are going to grow older and support the economy while the baby boomer cohort ages into retirement, while Gen X ages into retirement. And so the United States is on the same path that Japan is demographically. Moreover, I think the social implications could be worse for the United States because Japan is a very homogenous culture. And so high inflation, like Japan has, high debt to GDP, high government debt, this tends to lead to societal fractures, right? Inflation causes problems. When people are impoverished, crime increases. But thankfully for Japan, they have a homogenous society, right? And so there tends to be less conflict when you have a shared culture, shared heritage, shared, identity. You don't have that in the United States, which I'm not saying is good nor bad. It's just what it is, right? You have a variety of different cultures, different heritage, different identities, different values. And so the fracturing that is caused by inflation socially is going to be worse in a non-homogeneous society like the United States. So that's just something to be aware of as we go forward and as inflation becomes more of a problem long term. Right now, the Fed, again, we've talked about this a lot in last week's show, but the battle against inflation appears to have been won. They say they've won the battle, but the war is not over. And when you look at debt to GDP, which I'll flip back to this chart because super important. This is really, if you had one chart in macro, I would say it's this. It's debt to GDP continuing to go up generally, and debt more broadly, which we did a whole show on that. But this is going to lead to currency devaluation, which is going to cause problems in society. And that's why we're in Bitcoin. That's why we save in hard assets. And so I think the United States is on a similar trajectory as Japan, and we can learn from them, right? Save in hard assets. You know who's doing really well in Japan? Metaplanet. People that bought Bitcoin, companies that bought Bitcoin. It's no surprise that the first strategy copycat came in Japan. The first company to say, hey, strategy, MicroStrategy at the time, what they've done with the Bitcoin play has worked very well. It's no surprise the first successful clone of that came in the Japanese market because they have this structural inflation problem. It made perfect sense. On top of the fact that they had disfavorable laws for Bitcoin self custody. So that's kind of a tangential point, but it makes sense that Metaplanet was incredibly successful. And so if you're a Japanese investor, you want hard asset exposure, right? The yen continues to get devalued. You need to save in something other than the yen, Bitcoin, US equities, whatever. Anything's better than the yen. Take that same framework and apply it to America, apply it to the dollar, right? You got to save in something that's better than the dollar. It could be Bitcoin, it could be gold, real estate, whatever. And we can discuss the trade offs between them. But step one, to get on the same page, you got to be not saving in the dollar. That's kind of table stakes at this point. And so that's my spiel on Japan and the United States. And I think seeing turbulence in the Japanese bond market, again, highly likely that this is a sign Bitcoin is bottoming here. I'm super bullish on Bitcoin in 2026 and beyond, which you'll find out more if you read the report, which is coming out tomorrow. You can click the link in the description, newsletter.blockwareintelligence.com. We're going to be sending it out there tomorrow, free for everyone to read. Lots of high signal insights to unpack there. But now we'll get to the next exciting topic, which is the weather. We got to talk about bonds, and now we get to talk about the weather. But this has a big impact on Bitcoin miners because unlike Bitcoin or BTC, the financial asset, which is in cyberspace and you can't touch it, kind of an abstract concept, Bitcoin miners are very much physical. They're physical devices running at data centers, consuming real power from the grid or an alternative power source. And so, like physical assets, they are susceptible to physical conditions. Your real estate investment could be negatively impacted by weather, by a hurricane or an earthquake or fires, whatever. Bitcoin miners face a similar challenge. Now, thankfully for Bitcoin miners, your hard asset, which is the miner itself, very portable, right? So if there was a hurricane coming and you were a miner somewhere going to get impacted, like you could pack it up and move it if you had to. Or if the laws changed in your jurisdiction and Bitcoin mining was no longer welcome there, or it no longer made sense to mine Bitcoin there, you could, in theory, and it would come at a cost, time and financially, but you could pack up and move your operations. You can't do that with real estate. You cannot take your plot of land in California And when they start becoming socialist and passing all these terrible laws, taxing billionaires, letting homeless people poop in the streets, like you can't take your acre in California and move it somewhere else, right? You are cucked to your jurisdiction. When they don't let you rebuild after fires, there's nothing you can do, right? Your land is stuck there. Your asset is stuck there. It's immobile. Bitcoin mining has similarities to real estate. You get cash flow, you get tax write-offs, but you actually can move it to a different jurisdiction if you need to. So far more flexibility, far more long-term security, and less third-party risk with Bitcoin mining. Now, again, physical assets. What does this storm have to do with Bitcoin mining? Well, over 50%, and the estimates vary, but I would say around 50%, maybe more, of all Bitcoin miners are in the United States. It's pretty obvious why. I mean, this is for all of this country's flaws, you can still do business here. You still have property rights. Like this is still by far, far and away the richest, most prosperous country on planet Earth, best place to do business. And we have an abundance of natural resources and energy. Hands down, no brainer. This is the place to mine Bitcoin. Additionally, your initial concern and gut reaction, if you are a bleeding orange laser-eyed Bitcoiner, would be, doesn't this present a risk, right? All of the Bitcoin miners being geographically centralized in the US, isn't that a risk to Bitcoin? Well, thankfully we have 50 different sovereign states, and so property rights can exist all across the spectrum, right? You don't see a lot of Bitcoin miners in New York State or California. You see a lot in Texas, in Kentucky, in Oklahoma, Missouri, these kind of places. So thankfully, by having 50 different states, I don't view the concentration of miners within the US broadly as a risk. A bit of a tangential point. I promise we'll get to the weather and we'll talk about it because this is important. This is important to lay the framework and build the ground for the discussion, catch everyone up to speed if you don't really understand Bitcoin mining or if there's hanging chads in your level of understanding. So, Bitcoin miners, physical assets, most of them are domiciled in the United States, which is a good thing and it makes sense why. But this creates a very interesting dynamic where inclement weather in the US causes a noticeable impact on Bitcoin mining, on the total hash rate of the network. And I'll pull up a chart here, go back to the screen share. First, this is what we're dealing with. This is a record level ice storm about to smash the US. And I live in the South and we are woefully unprepared. So I'm actually very, I have personal eggs in the basket, so to speak. I'm curious to see how this goes. I actually got to spend time later today stocking up on gas for the generator, food, water, whatever. I think it'll be fine, but you never know. And so it's going to get really icy, really snowy. And if you're running a Bitcoin mining data center, there's two challenges here. First, the miners themselves are going to run less efficiently in extreme cold temperatures. They're computers, right? They're not perfect. They're susceptible to outside conditions and factors. And so if it's 0 degrees and ice everywhere, right, it's going to be harder to maintain consistent hash, consistent uptime. But they're also rowing against an increase in demand for power. It's really cold outside. Everyone wants to run their heat at the same time. Of course, you're stuck at home. You want to stay warm. You want to cook, whatever. So you have that factor as well, higher demand for power. And then you have the third factor, which is the grids could just flat out go out, right? With all the ice on the power lines, you could see a loss in power. And so all of this creates an environment where the hash rate, which is the total amount of compute on the Bitcoin network, is going to decline. And we've seen this before in the US when there is a storm, either in the winter or the summer, extreme cold or extreme hot. Now, this creates an opportunity. This does create an opportunity. It's not, it's not the end of the world. Bitcoin's the hash rate's going down. We're going to get 51% attack. Nothing like that is what's going on here, but it does create an opportunity for other Bitcoin miners. So I'll show you what we're talking about here. We have the Bitcoin price in black and we have mining difficulty in orange, which mining difficulty is effectively the same thing as the hash rate. Mining difficulty adjusts based on how many computers are mining Bitcoin. How much computational power is there towards Bitcoin mining? Miners unplug, mining difficulty goes down, miners increase capacity, difficulty goes up. And so there's a couple different things going on here. First, I think it's very worthwhile to note we have had one, two, three, four, soon to be five consecutive decreases in mining difficulty. So in the aggregate, since late October, early November, mining difficulty has been going down. Now, this fundamentally is actually a good thing, but what we know here is that the Bitcoin price has also gone down. And so there's this very interesting dynamic where the least profitable Bitcoin miners have to unplug first. Bitcoin miners are responsive to weather, changes in grid and energy conditions, as well as the Bitcoin price. If you're a Bitcoin miner and you have a relatively high electricity rate and your break even Bitcoin price was 100K, when Bitcoin went from 120K down to 80K, you had to unplug, right? You had to turn off your machine. And so what happens? Difficulty goes down. All the other Bitcoin miners become more profitable. If you're a Blockware client mining at 7.5 cent per kilowatt hour, your break even price was below 80K. It's somewhere between 50 and 60K, depending on your miner. You didn't have to unplug, but other Bitcoin miners unplugging makes you mine more Bitcoin. And so this phenomenon is one, it's beneficial for efficient Bitcoin miners, right? It's a dog eat dog world out there. There's no crying in business, no crying in the casino. So if you have an efficient miner with low cost power, you're better off in scenarios like this. But in addition, it sets a stage where the Bitcoin price can bottom because these inefficient miners with higher break even costs, higher electricity rates, outdated hardware, the ones that are unplugging, right here, you can see mining difficulty going down, miners unplugging, they were the ones selling the most amount of Bitcoin, right? If your break even price is 90K per Bitcoin and Bitcoin's at 100K, you're selling 90% of the Bitcoin you mine just to cover your electricity bill. Versus the guy whose break even cost is 50K, he only has to sell half of the Bitcoin he mines to cover his power bill. And so the guy who's contributing more sell pressure to the network, relatively speaking, he got kicked off or he went unprofitable. He's underwater. He's not in business at this moment, right? He's going to plug his miner back in when the price goes back up. But for now, he's out of the game. He's not selling Bitcoin. Less marginal sell pressure on Bitcoin means we're likely to make a price bottom. And that's a fascinating concept. And this is why it's very important to track the average cost of production for Bitcoin miners. There's not a uniform number for every miner, right? It could be 50K, it could be 100K, depending on your conditions, your setup. But you can do some calculations, and this is part of what I do at Blockware on a regular basis, and find an industry average. Right now, that industry average probably it's between, I would say, 80 and 95K in that ballpark. And coincidentally, that's where the Bitcoin price appears to be bottoming. And it's not really a coincidence, right? Because you get rid of those marginal sellers, you get rid of the weak miners, and typically, economics kind of 102 is commodities don't tend to trade below their cost of production, right? If it costs $1,000 to dig up an ounce of gold, that ounce of gold is not going to sell for less than $1,000 unless under extreme circumstances. Bitcoin's no different. It's a commodity that's finite, which is different in another conversation, but from the pure commodity perspective, cost of production, if it costs 80K to mine a Bitcoin, Bitcoin's really not going to trade below 80K. And you've seen this historically. Only in 2020, when the entire economy crashed in March with the lockdowns, did Bitcoin trade below its cost of production. Only when Sam Bankman Fried sold billions of dollars of paper Bitcoin and his Ponzi got exposed did we see this, right? It takes really extreme conditions for such an occurrence. And so, sure, if you're trading on leverage, maybe you want to avoid being around that, but around the cost of production in terms of your liquidation price, right? You could have a flash crash go beneath it. It's not a magic number that the Bitcoin price can't technically go beneath it, but generally speaking, it's going to be a good bottom indicator. And so that's one of the many things we're looking at Blockware that tells me personally, hey, this is a good time to be going after Bitcoin, increasing your position, increasing your exposure, buying Bitcoin miners, positioning yourself for the next run up because it's still not consensus. And I'll get off the screen share here and off the soapbox too, but it's going to be a good year, right? I think, and I talked about this on Twitter a little bit last week. There's a trade I'm watching, and it's the re-entrance of the cycle traders. On top of all the other bullish conditions that we've discussed today, that we're discussing in this report, on top of all of that, there's the idea that the people who sold Bitcoin in Q4 of last year because they pulled out their calendar and they said, 4-year cycle, boom, this time, 18 months after the halving, I'm selling no matter what. The cycle is still on, right? I missed it in 2021. I kept holding. I ate a 75% drop. I'm not doing that again. I'm selling. It's going to happen. Those folks, are they bearish Bitcoin? No, they're not long-term bearish Bitcoin. Maybe you're a diehard Bitcoiner and you would say that that behavior is bearish, but they're not out of the game, right? They're not never coming back. They're not a capitulator. They're not the guy who got burned on BlockFi and Celsius and Luna and is like, I'm done with this crypto crap. This is a scam. Get me out of here. This isn't those people. This is the people that are generally sympathetic or even understanding of the Bitcoin thesis on currency debasement, fiat currency, whatever. And they like Bitcoin, but they also want to trade, right? Human nature, greed, it afflicts us all. It's a battle everyone must face internally. But this is that type of person. They like Bitcoin. They think it's a great investment long term, but they think because of the cycles, it has to go down in 2026. And we're reaching this make or break point where these folks have to decide, are they really going to be on the sideline for this year with QE, with institutions continuing to stack hundreds of thousands of Bitcoin every quarter, right? Do you want to be on the sidelines during that environment? Because this is not the same scenario as 2022 when you had the BlockFis and the Celsius and the Terra Luna and the Three Arrows Capital and the FTX blowing up. When you had the Fed just absolutely hiking rates through the moon at a record pace. This isn't happening in 2026. You've got an entirely different fundamental condition. You have an entirely different cohort of market participants. You have a base, right? You have Bitcoin at the cost of production. You don't have Bitcoin coming off of a 3K to 60K run in 2021 or 2020, right? In 2022, Bitcoin just had this massive move higher in the preceding 18 months. It was ripe for a drawdown in hindsight. Makes total sense why we had a 75% correction. You don't have that in 2026. And so these cycle traders have to decide, are they going to come back into the market? And I think we will. I think we'll see that with haste in Q2. I think we're going to reach some price around 100K where, all right, they raise their hands, they capitulate. I was wrong about the cycle, and they come back in with force. That's not going to send Bitcoin to 200K, but it could be a tailwind. And so that's something I would keep an eye out on. I think this is going to happen in the coming months. We're going to see this trend play out. And I'm excited for that. Along with all the fundamental bullish catalysts for Bitcoin, I think this is an under-discussed boost that could send Bitcoin higher. But in order for those folks to kind of confirm that their initial hypothesis was incorrect, we're going to have to see more gradual recovery for Bitcoin, right? Bitcoin continuing to grind higher off that 80K bottom. We went up to as high as 98. Now we're back down to 90. But I think once we solidly pass 100K, which could happen in the next month or two, then we're going to see those cycle traders come back into the market. And so that was a bit of an off the cuff rant or tangent or whatever, but hopefully that makes sense to you guys. Let me know what you think. Leave a comment down below, leave a chat. And also, that's something I'm going to start doing. I'm going to start reading the live chat. I haven't done it yet, and I want to, right? But I'll be totally candid. My fear is it's going to distract me, right? I have a lot of thoughts in my head. My internal monologue is very loud, and so I want to communicate those thoughts as clearly and effectively to you guys as I can. Hopefully you learned something today. Hopefully you were entertained. And one of these days I'll start reading the chat. I do always read it after the fact. But I would like to create a bit more of an interactive environment. Perhaps I'll start reading chats at the end of the show. We'll see. We'll see where it goes. Still winging it, kind of. Not really. I come prepared, but figuring this out as I go. I'm enjoying the live stream. I've had a lot of positive feedback, so thank you to everyone who has Sent in feedback, said, "Hey, this is I like it, whatever." Hopefully you guys are getting value. Continue to like the stream. Make sure you're subscribed to the YouTube channel. Make sure you're following us on X, on Rumble. Retweet this. I'm also putting out clips. We've got some clips going out, short form and kind of longer form. So make sure to share those. Hopefully the sound bites are at the very least what you can listen to, right? If you don't listen to the whole stream, maybe you can catch some clips. Maybe you can learn something because this is a challenge, right? Can you talk about the bond market at a sophisticated level without losing the audience's attention? I'm up for it. Hopefully, you guys learned something today and got some entertainment value as well. Without further ado, make sure to smash the like button, leave a comment, do all that stuff. Follow us on Substack to subscribe to the newsletter. Again, we're going to be sending out some very high signal content tomorrow. We'll break it down on the show. And also, I'm not going to totally spoil it, but we've got a super big collaboration in the works. It's with a Bitcoiner, I'm not going to say his name, but it's coming within the next couple of weeks. Super excited about that. I think you guys are going to receive a lot of value from that. So keep an eye out. Make sure to follow us on X and let me know how I did. Let me know what you think about the show, and we will see you guys